Welcome to the deep dive. If you're trying to figure out the difference between a really high quality business and, well, a high quality stock price, then you are definitely in the right place. Today, we're diving into one of the sharpest disagreements you'll find on the market right now, Pool Corporation. Ticker, Pool. Now, this is a business that has the ultimate stamp of approval, right? Warren Buffett's Berkshire Hathaway is a major
A
owner.
very significant owner, yeah. But
But at the same time, you've got 10% of the public shares being shorted. I mean, that's a huge number of investors betting hard against its immediate future.
it really is a classic standoff. Is this your moment to, you know, buy the quality dip, follow Buffett, or are the bears seeing something serious coming, like a cyclical storm that's just starting?
That's exactly what we're here to figure out. We've got the research. It's current as of September 24th, 2025. Stock closed at $312.63 then. Our goal is to really understand how durable this business is, look at the valuation, and pinpoint what exactly those short sellers are worried
Well,
about.
let's start with the absolute basics, the foundation.
Okay, we'll kick off with Chapter 1, the business of backyard leisure, understanding Pool Corp. So let's just establish, what is Pool Corp? Because when people hear pool company, they often think luxury home building, right?
Mhm.
Super discretionary, very cyclical.
Yeah, and that's the first critical distinction you have to make.
Yeah.
Pool Corp isn't the company pouring the concrete for a new pool. And they're not the ones making the pumps or the filters either.
Okay, so what are they then?
They are the world's largest wholesale distributor of pool supplies and equipment. Think of them as the giant warehouse and logistics network behind the scenes. Their edge is pure scale.
And that scale is, well, pretty staggering. Something like 450 sales centers around the world, serving, what, 125,000 professional clients?
Exactly. Those clients are your local pool builders, your weekly maintenance folks, the repair technicians. Pool Corp is the essential middleman supplying them.
The middleman,
Yeah.
okay.
And being that middleman lets them operate this kind of razor and blades model. Sure, new pools mean big initial sales, but the key insight from the research is that a massive 62% of their revenue in 2023 came from non-discretionary maintenance and minor repairs.
62%. Wow. So chemicals, replacement parts, filters, stuff people have to buy.
Precisely. Things you need regularly just to keep a pool working and safe, no matter what interest rates are doing.
Yeah.
It creates this amazing, almost annuity-like income stream.
That sounds incredibly resilient. So if 62% of the revenue is that stable, why the huge short interest? Doesn't that maintenance side cushion them from a construction slowdown?
Well, that's the tension, isn't it?
Yeah.
That's what the market's grappling with. The maintenance revenue definitely provides a high floor for earnings, but the stock's valuation often gets pushed higher based on growth from new builds and renovations. And that part is slowing down.
Okay. So the core business is solid, but the growth story is hitting headwinds.
Exactly. But that core business, that moat, is just formidable. It's built on that infrastructure.
Right. Trying to replicate 450 senders, handling over 200,000 different items from like 2,200 vendors. That seems incredibly difficult.
It gives them huge product breadth, and because they're the biggest player by far in a really fragmented industry, they get significant pricing power too.
And on top of that scale advantage, there's a regulatory push helping them out now.
Yes, a really powerful one. There's a U.S. Department of Energy ban on the old, inefficient, single-speed pool pumps. It actually just kicked in this month, September 2025.
Okay. And the impact of that is?
It forces homeowners, when their old pump dies or during a renovation, to upgrade to newer, much more expensive variable speed pumps. So basically a government-mandated upgrade cycle,
Which should drive demand for higher ticket items straight through Pool Corps' warehouses.
directly through them. It's significant non-cyclical demand expected over the next few years.
Okay, interesting. Let's shift gears then and look at who's steering the ship. That brings us to Chapter 2, evaluating the captains of the ship, management and capital allocation. How's the leadership team doing, especially navigating this post-pandemic slowdown?
Well, the leadership seems very stable, very experienced. You've got CEO Peter Arvin, who has a background in distribution, and CFO Melanie Hart, who's been there quite a while, since 2006.
And they've shown they can handle tricky situations.
Absolutely. Look at how they managed inventory coming out of that huge pandemic boom. Demand shifted rapidly, and they successfully cut inventory down by $230 million in 2023. That kind of discipline led directly to a record $888 million in operating cash flow that year.
That operational skill really shows up in the numbers, doesn't it? Particularly the return on invested capital, the ROIC. It's stated at a remarkable 23.5%.
Yeah, 23.5% ROIC is, well, it's fantastic. It basically means for every dollar they put back into the business, they're generating almost 24 cents in profit. That's the sign of a truly high-quality operation.
A real compounder.
Definitely. It means they throw off enormous amounts of free cash flow without constantly needing to raise more money.
So when a company generates that much cash, the big question is always, what do they do with it? Are they reinvesting smartly for growth or just sending it all back to shareholders?
They seem to strike a good balance, actually. They do invest in growth. They buy smaller competitors, these bolt-on acquisitions, and they open new locations organically. They plan 10 new centers for 2024.
Okay, so growth isn't ignored.
Not at all. But they are also very focused on returning cash to shareholders. In 2024 alone, they sent back $483.4 million. That was about $180 million in dividends and over $300 million in share buybacks.
And that dividend record is pretty strong, isn't it? Something like 14 straight years of increases.
14 consecutive years, yes. Plus, they consistently reduce the share count through buybacks. It's a powerful signal from management, especially during a slowdown. They're basically saying, we believe the long-term cash flow is solid, even if sales are temporarily softer.
Right, signaling confidence in the underlying business despite the cycle. Okay, let's get into the recent financial picture. We're moving to Chapter 3. Diving into the numbers. A financial health check. We know things are normalizing after the pandemic surge. What did that look like in 2024?
Yeah, normalizing is the key word. You have to see the numbers in context. So yes, net sales in 2024 dipped by 4%, down to $5.3 billion.
A dip, okay.
But, and this is really crucial, the $5.3 billion is still 73% higher than their sales back in 2019, before the pandemic. It suggests the pandemic really lifted their baseline level of business permanently.
73% higher than pre-pandemic levels. That's quite a reset.
It really is. And look at their gross margin. Even with sales slowing a bit, it stayed very stable at 29.7%, only dropped 30 basis points.
Which suggests they still have that pricing power, right? They can mostly pass on costs.
It seems so. It's a good test of that moat we talked about. And their cash generation stayed strong too, backing up that focus on the non-discretionary side. They generated a record $659.2 million in cash from operations in 2024. Even in a slower year, the cash machine keeps humming.
And the balance sheet looks okay, debt manageable.
Yeah, it looks pretty solid. Debt to equity is under 1 at 0.93. Liquidity looks good with a current ratio of 2.52. And they're actively paying down debt. They reduced it by $103 million in 2024.
Okay, so financially sound. Let's put a number on the valuation then. Market cap is around $11.7 billion. You mentioned the price to earnings ratio earlier.
Right, the TTM/PE trailing 12 months is sitting somewhere between 29 and 30.
And how does that compare historically for them?
It's just a touch above their own 10-year average, which is around 29. So not wildly out of line, but maybe a slight premium.
And versus competitors?
Well, it's higher than some of the equipment makers like Pentair, which is also around 30 times earnings currently. But it's way lower than, say, SiteOne Landscape Supply, which is more of distribution peer in a related space. They trade closer to 49 times earnings.
So the market is pricing Pool Corp as a quality company, but maybe fully valued. Or perhaps reflecting the current slowdown.
Could be a bit of both.
Yeah.
It definitely leads us into the current market view. Let's move to Chapter 4. Market sentiment. What are the analysts saying right now?
Yeah, what's the consensus?
It's pretty lukewarm, honestly. Mostly hold ratings, maybe some moderate buys. The average 12-month price target is somewhere between $338 and $342.
So only suggesting maybe a 6% to 9% upside from where it was trading, not exactly screaming buy.
Not at all. But the really fascinating part, as you mentioned earlier, is that short interest. 10.01% of the public float held short. That's a huge number for a company like this.
It's a massive contradiction, isn't it? Blue chip reputation, solid financials, Berkshire on board, yet 1 in 10 public shares is betting against it.
And the short seller's argument is almost entirely focused on the macro picture in the cycle. They're betting that high interest rates will really hammer new pool construction and big renovations for longer than people think.
And that maybe those strong margins can't hold up indefinitely if demand stays weak.
That's the bet. That they'll either have to cut prices or see volumes drop further. You can see this tension reflected in the stock chart, too. It's been trading sideways, kind of stuck between its 50-day and 200-day moving averages. Total indecision.
So who's taking the other side of that bet? Besides the analysts with their modest targets. Let's look at Chapter 5, ownership structure. You said institutional ownership is high.
Extremely high.
Yeah.
Somewhere between 89% and 99% is held by institutions. These are generally the long-term holders.
And the biggest name among them, obviously, is Berkshire Hathaway.
Right. They own 9.27% of the company. That's a stake worth over $1 billion. And what's really telling is that Berkshire significantly increased that position in the first half of 2025.
While the short interest was high and the stock was maybe stalling out.
Exactly. When arguably the world's most patient, value-focused investor steps up and buys more during a period of uncertainty like this, well, it's a massive vote of confidence in the long-term quality of the business. It suggests they see the maintenance revenue as a strong floor and think the market's too worried about the short term.
That's a powerful counter-argument to the bears. What about insiders? Management owning shares?
Insiders hold about 2.7% to 3.0%. There has been more selling than buying recently, but you have to be careful interpreting that. A lot of insider selling is through prearranged plans for diversification or taxes, so it's not always a signal about the company's prospects.
Right, not necessarily a lack of confidence. The Berkshire buying seems much more significant.
I would agree. It speaks volumes more than routine insider sales.
Okay, now we absolutely have to dig into the risks those short sellers are focused on. Let's go to Chapter 6. Risk assessment. The macro risk high rates, inflation is clear. Can you elaborate?
Sure. It's pretty straightforward. High interest rates make borrowing money expensive. That directly hits demand for big-ticket, discretionary items like installing a brand new swimming pool or doing a major backyard renovation. It deters people from taking on large projects.
And that's what slowed things down in 2024 and is expected to continue.
That's the primary driver, yes. But there's a significant new threat that just emerged. 2025 tariffs.
Ah, right. The government imposed new tariffs on imported goods.
Yes, quite significant ones, rates between 10% and 50% on a broad range of goods. Now, Pool Corp is a global distributor sourcing, remember, over 200,000 different items. Many of those are likely imported.
So this directly increases their costs, their cost of goods sold, or COGS.
It absolutely will. And this becomes a really critical test of that competitive moat we discussed earlier. They have huge market share, maybe 65%. Does that give them enough pricing power to pass these new tariff costs straight through to their professional customers?
Or do they have to absorb some of that cost themselves, especially if demand is already soft because of interest rates?
Exactly. If they pass it all on, do they risk losing sales volume? If they absorb it, their margins get squeezed. This tariff pressure is probably the bear's strongest near-term argument, say for the next 12 to 18 months. It adds a layer of cost uncertainty on top of the demand uncertainty.
Okay, that really crystallizes the bull versus bear debate. Let's try to bring it all together now in Chapter 7, conclusion. Can you quickly recap the opposing cases?
Sure. The bull case rests on really solid pillars. You've got unmatched scale and a deep competitive moat. You have that large annuity-like recurring revenue from maintenance, which is mostly non-discretionary. You have excellent management proven by high ROIC and smart capital allocation, including those rising dividends. And of course, you have the massive validation from Berkshire Hathaway buying more shares.
A very strong long-term picture. And the bear case.
The bear case is all about the now and the valuation. You've got the cyclical headwinds, high rates, maybe a weak housing market impacting renovations. You have this new pressure from tariffs, potentially squeezing margins. The valuation at 29, 30 times earnings is seen as full, leaving little room for error. And all of this is reflected in that high 10% short interest.
Timing and price.
Yeah.
So where does that leave us on intrinsic value? You mentioned a DCF model.
Yeah, we used a discounted cash flow model just as an educational tool, really, to frame the potential value. Remember, these models are very sensitive to your assumptions. But using what we felt were pretty conservative inputs, like a long-term growth rate of only 2.75% and a discount rate between 8.5% and 9.5%, the model suggests an intrinsic value range of roughly $285 to $353.
Okay, $285 to $315. And the stock price when this research was done was $312.63.
Right, so trading very close to the upper end of that estimated fair value range.
Yeah. Which means the final judgment really comes down to an investor's time horizon, doesn't it? Is today's price, near the top of that fair value estimate, a reasonable price to pay for what seems like a best-in-class company that's just weathering a temporary storm?
That's precisely the question you need to ask yourself.
So hopefully you now have the full picture. The underlying strength of the pool maintenance business, that incredible cash generation, but also the very real forces rates, tariffs pushing against it right now. And here's something to think about. With that regulatory push forcing upgrades to expensive variable speed pumps, and knowing there are about 10 million pools already installed in the US, many of them aging, just how much predictable, non-discretionary replacement revenue has Pool Corp essentially locked in for the next decade, almost regardless of what the housing market does day to day. We really hope this deep dive helped provide some clarity. If it did, please like and subscribe to the Stock Analytics AI YouTube channel. Remember, for just €4.99 a month, members get priority deep dives on tickers. We're planning to cover all of the S&P 500 stocks over the next few months, and members get first dibs. Or if you just want a specific deep dive done for you, drop us a super thanks.
And just a necessary reminder, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be taken as financial advice. Please always do your own research or consult with a qualified financial advisor before making any investment decisions.